Hello everyone. Welcome to Theme Talks on HDFC Manufacturing Fund. Today, Theme Talks is a initiative by HDFC AMC where different fund managers and specialists speak on different themes in the Indian market. I'm Siddharth Gupta, product specialist at HDFC AMC, and your host for this call. Today, we will be discussing the investment opportunity in the Indian manufacturing space in the wake of tariff turbulence. We are in a especially VUCA world where things keep changing on a daily basis. We keep learning new things about the tariff structure, about the way and new theories about the way the world will evolve in this whole the different actions that the US administration is taking. More specifically, we will be discussing the Indian manufacturing theme and how it is the key to India's economic growth ambitions. Why we believe that Indian manufacturing could see its journey from 15% or 14% of GDP to about 20%. What are the impacts of tariffs on Indian manufacturing and how we at HDFC Mutual Fund are navigating these times via a portfolio strategy in the HDFC Manufacturing Fund. This fund was launched by us in somewhere last year around May. May 16th was the first NAV date. It allows investors to take exposure to the wide universe of Indian manufacturing, as we will see in the coming time. I'm honored to have Mr. Rakesh Sethia here, who is the fund manager and senior equity analyst with us. He has about 18 years of overall experience, and of which about 5 years are with us now. He has been the fund manager for HDFC Manufacturing Fund since inception. Rakesh, great to have you here with us.
Yeah, thank you so much, Siddharth, and thank you everyone for joining the presentation. What I will do is I will cover. So basically, what I want to cover is why the manufacturing is important for growth, especially India's growth aspiration. Why it is time has come now. Sorry. Yeah. So why manufacturing's time has come now, and finally, I will also touch upon the fund strategy and key specifics around the fund in the next 15-20 minutes or so. So firstly, on why do we need manufacturing? I think three important macro points. First, we need to drive the growth for our economy. We need to create a lot of jobs. A lot of jobs need to be created our economy for a sustainable growth in the coming years or so. And finally, macroeconomic stability. We need to have some framework where we can control our current account deficit, and also we can control our inflation. And why these variables are important, I'll highlight in the next few slides. So if you look at the economic growth, and this is a case study of many successful economies over the last 50 years or so, what you would observe is that the economic growth has largely been driven by increasing share of manufacturing in those economies. So take example of China. For 15 years, their economic growth was about 10% in real terms. During the same time, the share of manufacturing increased from 9% to about 32% now. You take example of Vietnam, which is a very recent successful economic story. Their share of GDP increased from 19% to about 26%. And then during this time, they were able to grow about 6%. Remember, Vietnam is a very small economy. So for them, the 6% growth rate is quite substantial relative to their scheme of things. As when it comes to India, our share is about 14-15%. We think it can go to about 20% in the current scenario, and potentially higher in the future, but the targets looks achievable. So the conclusion is that if any country needs to drive their economic growth, manufacturing at some point of time has to pick up to do the heavy lifting. Secondly, we have about 45% of our population is currently involved in farming. 60 to 70% of that population 45% of the labor force is in agriculture, And of these population, about 60 to 70% of what we call they do sustenance farming, which means that in the end of the year, they don't have much surplus which they can sell into the market. So that's a starking situation. We can say that, it's some form of, it's a disguised unemployment for our economy. When you look at RBI data, what it suggests is that when a person is moved from, let's say, agriculture to services or manufacturing, the economic multiplier is about 4 to 5 times. So take an example, if a person, let's say, value at about 70,000 rupees in agriculture, and if the same person were to be moved in services or the manufacturing, the value at addition could be as high as about 3,30,000 in case of services and about roughly 3 lakh rupees in case of the manufacturing, right? So that is the key driver, that why we need the manufacturing. Specifically, when you tie up the farm people who are not able to produce surplus, if we somehow we are able to move them into the factories, I think we can create a lot of not only jobs but also a lot of employment and as well as the economic growth for the country. And it's a new template. The same template was followed by China in 1990s. Roughly 25% of China's population was involved in farming, and since then this number has come down to about 5-6%. But the GDP per capita has increased from $200 to roughly about 12,000 odd dollars now. And by interestingly, India also had the same level of GDP per capita in 1990. India has also grown. It's not that we have not grown, but the difference is when we are at about $2,500 per GDP per capita, they are about $12,200 GDP per capita. And the difference is largely that in some sense we missed out on that manufacturing bus, which probably need to, which we need to fix so that the growth of our economy and a lot of jobs can be created for our economy. Finally, is the macroeconomic stability. Look, there is nothing wrong in not having the manufacturing because we have become a very large country. We have need obviously a lot of consumption, and we can import that consumption, right? Fundamentally, one could argue what's wrong in that. Specifically in the context of some academic theories about trade and all, right? But the problem with that is that when you have a country as large as ours, it creates these macroeconomic imbalances. So take an example, if we keep importing, by nature our currency depreciate, which means that every year, if our currency depreciate by let's say 3.5 to 4.5%, as what we have seen over the last 15-20 years or so, the inflation becomes sticky. So we have dual problem. On one hand, we have this large current account deficit, which is bad for the currency. Currency depreciates even more, and that feeds into the inflation. So in some sense, inflation becomes sticky and structural to the economy. Such is not viable model for a country like ours. And interestingly, when you see the other economies like China and Vietnam, their inflation has been about 2-3%, when our inflation has been about 5%. Both of these countries run large current account surplus. Vietnam is running about $6-7 billion of a trade surplus. Versus that, we are running a large trade deficit. So in some sense, we need manufacturing to fix these trade balances for our macroeconomic stability. So why the manufacturing now? Why? I think the real sense. There is. I use this framework to analyze that. What is the opportunity? Do we have the capabilities to capitalize on this opportunity? And finally, how is the business environment? So when you look at in this framework and you sort of plot the current manufacturing base, the first is the large consumption base of our own country. This is the single biggest driver for the manufacturing in our country. What a large base does is that we become very large consumer. We have become either first, second, or third largest consumer in many of the products outside the China in the whole world. That gives us a scale, and that scale is coming at a time when the export opportunity is becoming large, right? So cost competitive production for your own manufacturing and then using it for the purpose of the export is the key opportunity from a theme perspective. And to capture this opportunity, what our country has in terms of capability is a very large and skilled labor pool. We have cost advantage versus peers. So on an average, where China used to be cheaper, 10-15 years down the ago, it's not the case anymore, right? There are many industries. I'm not saying for all the industries we have become attractive or cheaper, but there are many industries which are labor intensive in their nature, And because our labor cost is one of the lowest in the whole world, in some of those industries, our cost of production is actually turns out to be cheaper as compared to many of the peers. Finally, the infrastructure is also improving in our country by leaps and bounds, as reflected in government spending. That adds up to not only the cost competitiveness of the country, but also the reliability as a supplier. That is also very important, and which is where I think this has been one of the key game changer. Finally, when look at this opportunity and these capabilities in the context of the environment, so first of all, the government policies are very favorable. What government wants to do is drive Atmanirbharta or self-reliance. That's a very important policy, which is very good for the business environment, specifically for manufacturing set of companies. Secondly, even if you don't include government and just look at the balance sheets of the companies, or you look at the where the utilization levels are some of those companies, we are reaching at what we call that would be an incremental growth cycle. To drive the growth, they need some of these companies would require to invest in the capacities, which means more growth in the future. And this growth would be funded by their own balance sheet, because largely the state of the balance sheet is quite healthy, probably healthiest what it has ever been in the history of corporate India. And finally, when you look at the macroeconomic stability, or even you look at geopolitical factors, when people are talking about moving their supply chains, I think India is one of a favorable geography where a lot of such opportunities could emerge, and India and some of our companies, some of our sectors could potentially leverage on the same. I'll also touch upon some of the key trends which is driving. So first one is the consumption, as I was highlighting, that the consumption is one structural trend driving the manufacturing. And one of the key driver is this income pyramid. So for example, when you look at, let's say, 2021, what we would call roughly 60% of the population is middle class to upper middle class, right? The same number in 2031 is likely to be about 80%. So the entire middle class population base is increasing because people from lower economic strata is moving to the higher level of incomes. What it does is, two things. First, the discretionary consumption starts to increase, and within the discretionary consumption, you see trends of premiumization. And because we are a very large population, by definition, it gives us a very large market. So take an example of a couple of products which I have on this chart on the right hand side. Take an example of AC, right? In 2013, what we sold was roughly about 3.3 million, or roughly about 33 lakh ACs. Last year in 2024, we sold about close to about 1.1, 1.2 crores, right? So the number have increased multifold over the by a factor about 4 times. From the fifth largest consumer of the room ACs in the world, now become the second largest. And because of that, we have become cost competitive. A cost competitive plant of room AC requires a volume of about close to 10 lakhs, which means in 2013, we could have put only 3 plants. Even if we wanted to be cost competitive, the challenge is that, look, if you put a plant in south, how we will cater to the demand of the north, and the vice versa. Same problem is not applicable anymore. Why? Because with about 1.2 crores of AC sold last year, we can theoretically set up 12 factories, and we are growing about 1.5 factory every year. Which means that the problem of logistics north, west, south, east is not applicable anymore, and the cost competitive plants can be set up not only to meet your own domestic requirement, but potentially even export at some point of time in the future. That I would argue will not be too difficult and ask over a 5 year period. Same example can be seen in many other products, whether it's smartphone, washing machines, refrigerator, or even cars, right? The point is the manufacturing for the local consumption is the big structural driver for the theme. Secondly, when you look at some of the near-term data, that is also quite encouraging from a consumption perspective. First is the tax cut. Obviously, that gives the boost to that is likely to give boost to the near-term consumption, because the absolute amount what government is expecting is about close to 1 lakh crores. When this goes back into the economy, it will have a multiplier effect of its own, right? So that's one factor that will drive the near-term consumption, probably mostly on the semi-urban and urban side. Secondly, when you look at the rural, which is where I think, where a lot of these direct dolouts that has happened by the governments over the last 12 months or so, especially during the time of election, that is finally started to trickle down in the economy. And for large part of that population, or large part of the beneficiaries, there is substantial portion of their discretionary income. That means more money in their hands, which can be spent. Also, when you look at inflation, or when you look at the monsoon, these two data points, they're quite favorable as compared to what it has been in the last 2 3 years, right? So RBI has also spoken about a reasonably a benign forecast of the inflation in the coming years, that leading them to do two rate cuts already and possibly more. All these are good for the near-term consumption, one could argue. Second important driver is the capex. What we one could argue is a combination of infrastructure spend as well as capital investment by both public and the private sector. So government has already done the heavy lifting, what we have seen in the last couple of years. So for example, the roughly 2 lakh crores of the capex in about 2018-19 is now reaching close to about 12 lakh crores, right? So substantial heavy lifting has already done by the government. And it's not that the number is stopping. The number is more likely to grow with the nominal rate of GDP even in the coming years. What was missing so far was the private capex, but when you look at the data of the listed entities for the last 2 years, even the private capex seems to be on the revival. While the data is not there of some of the unlisted companies in the public domain also, but when we look at, let's say, data from MCAs, and we look at some of the new capex that has been announced, for example, semiconductors and solars, large part of that capex has also come in the economy, but in the form of unlisted space. So overall, seems like that the entire capex cycle is also in a healthy pace of growth, which is also very important for the economic growth and for the manufacturing, specifically in the context of the demand for industrial goods. Finally, in the export side, so the two important trends out here is, our share in the merchandise export is very low. That's about 1.8%. Frankly, for the rest of the world, we don't matter when it comes to global trade. Secondly, this is happening at a time after the COVID. There's a lot of focus on the moving the supply chains or having an alternative to supply chains, what we call moving beyond China. That is where I think, chart on the left hand side is a key indicator that why India is emerging as one of the alternative geography. When you look at our labor cost, and as you compare them to either China or some of the other, let's say, Southeast Asian economies, which are our competitor, one could argue, for example, even in Thailand, Vietnam, or for that matter, in Malaysia, we are scoring very well as compared to them on the labor cost basis. It is fair to argue that in the coming years, at least the labor-intensive manufacturing is more likely to emerge as a key winner in our economy as compared to anything else. And some of the, if you look at some of the data points, for example, in EMS industry, which did not even exist just about 6 7 years back at a large scale. In the last 4 5 years, the growth has been substantial, and one of the driver has been the labor cost, right? Because in some of these industries, the labor cost is anywhere between 4 5% to about going as high as about 8 to 10%. In those kind of cost structures, it makes sense to move the manufacturing in India, which is what we have seen in some of the examples. Finally, on the tariff, which I think is I would want to spend some time here, which is a very topical discussion at this point of time. So when you look at there is a lot of uncertainty around the tariff, especially specifically from the near-term context, right? So we really don't know how it will play out, at least in the near term, and therefore, to argue on either side would be misleading. What I would argue that look at the issues that has been raised by the large trading partners, and then do a logical analysis and see whether we can get let's say, a favorable trade deal, or probably we can come out as probably come out with some sort of a structure which is win-win for both the trade partners. So when you look at the US and you specifically look at the two issues raised by them, first is a large trade imbalance, and secondly is the differential tariff. So first one, I think, is India doesn't even matter. So if you look at chart on the left hand side, when US talks about large trade imbalances, they're essentially talking about China, they're talking about Mexico, they're talking about Canada and countries like Vietnam. Vietnam is a smaller economy, but look, they're running $123 billion of trade surplus with US. China, 295 billion. India is only about $45 billion or so. I think this is an easier problem to solve for India. or I would call it, just by moving or rerouting some of our energy and the defense imports, we can address part of this problem. But that will not be the only thing. I think, of course, the endeavor has to be where increasing the absolute size of the global trade on both the sides, or absolute size of the trade between both these two economies, which I think is a likely scenario that may play out in the coming, we'll see in the coming months how it plays out. Secondly, the differential tariff is a tricky one. The reason is that some of the asks from the US could be tricky to address. For example, agriculture is one of them, where because our farmers get a lot of these support from in form of MSP, and if those barriers are being lifted, it is possible that some of those prices could be deflationary in the nature, where imports can become cheaper, and therefore there will be a repercussion, or second derivatives of some of those effects can play out, right? We don't know about that, but one could argue that on a net basis, I mean, government obviously has to figure out a policy around the same. I'm not a policy expert and I'm not devising anything on the same lines, but it is logical to argue that as long as the principle is to grow the absolute trade, bridge the trade balance, I think there is a reasonable case where both the economies can figure out win-win trade deals, and that possibly can and potentially happen. Of course, there could be local winners and losers that potentially might pay out, but I think on an aggregate basis, both the economies are more likely to gain as compared to lose if the trade deals were to happen. Finally, when you look at the near-term policy, even when the reciprocal tariff were announced, what you saw was India has actually been hit with relatively lower rate. Or if you look at just on a plain simplistic basis, it's about 26%, but on a trade weighted average, it's about 25% or so, right? So it's a smaller number, whichever way you slice and dice the data as compared to the others. So that tells you that even if the situation remains the same, just on these duty arbitrages, some of the sectors are likely to gain as compared to other geographies. Some specifics around the funds of the investment strategy. First of all, the core portfolio, uh, at least 80% of the portfolio would always be invested in the stocks that represent this diverse theme of the manufacturing. At this point of time, we are way above that number. If I remember my number correctly, I think it's about 94% of the portfolio is already in the manufacturing theme, and some of the remaining 5-6% what we is not manufacturing has an indirect exposure to manufacturing, is how we have looked at some of those stocks. Finally, the stock selection or the investment style is largely bottom up. We are generally a research driven house, and therefore we focus on stock selection based on a fundamental bottom up analysis. And specifically for this fund, the endeavor is to figure out the companies which are more likely to have a long runway for growth in the coming years. Portfolio is very well diversified. Currently, at this point of time, about 83 stocks. But endeavor is to always have a reasonably well diversified portfolio as an investment strategy. Finally, on when you look at the market cap spectrum, I think a right way to look this would be in some sort of a, it allows you to be flexible across the market cap. And one of the reason is the next slide. So when you look at the list of the companies or number of sectors that it allows you to be invested in. So you look at the number of sectors, there are roughly about 14 sectors in which one can invest. And if you look at the basic industries within these 14 sectors, there are about 82. So 82 basic industries becomes eligible to be part of the manufacturing theme. And when you look at the number of companies, even by putting a threshold of above 1,000 crores, roughly 713 companies qualifies to be part of the manufacturing theme. And all of these combined clubs up to about 37% of the market cap. So large part of the market cap is covered through this theme. What it essentially does is that it allows you to build a diversified portfolio, not have exposure to one particular sectors. I mean, the way I think about this fund always is, in some sense, it's more of a flexi cap approach. Why? Because it allows you to do the portfolio construction across different market caps. And in terms of number of stocks, you don't have to be in 10 or 15 or 20 stocks. The number of stocks could be as broad as what you typically see in a flexi cap portfolio. Finally, from a market cap perspective, at this point of time, when you look at these companies, potential companies, right? Roughly 54% of these potential companies are in the large cap, and another 45% are split evenly between mid and small cap. So whichever way you slice or dice, the conclusion is the theme as an opportunity allows you to invest across diverse market cap spectrum and across diverse spectrum of the number of industries, and obviously the number of companies itself is quite large. The current portfolio, the current fund size is about 11,500 crores. Top 10 stocks are about 37% of the portfolio. At this point of time, the fund is largely fully invested. About 99% is invested. And in terms of market cap, 65% is towards large cap, 35% is towards mid and small cap. So when you look at the current portfolio and some of the sectors, what you would observe is that portfolio is very well diversified in the especially in the current market construct where valuation is quite elevated across sectors. The top active share or the total active share in the portfolio is about 46%. This share is more likely to increase as valuations becomes more reasonable across market cap spectrum. Some of the other key statistics around the fund out here, I will not spend too much of time because it's already been covered in my previous remarks. Uh, so as a conclusion, why invest? I would argue that the theme offers give an exposure to multiple themes. It's a combined play on the entire GDP. The three components of GDP is consumption, capex, and exports. This theme gives exposure to consumption as our consumption is growing in our economy. It also gives opportunity to take exposure to the changing geopolitical dynamics in the context of the supply chain movement across the world. And finally, India is emerging as a manufacturing powerhouse in the context of its own local consumption.
Thank you, Rakesh. I think this was a very productive call.
Thank you so much. Thank you everyone for your time.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.